Well, welcome back. Here we are, kicking off 2025. It's a new year. There's a new beard, and hopefully, we have some news to be able to share with you. Let's just jump right in.
Yeah.
What I know that there's been some pretty big shifts as it relates to some Fed commentary back in December and things like that. So, where do you want to kick us off today?
Well, I think kicking us off at like a broader macro view of what's been happening and what's been driving markets over
Hmm.
the past couple of years. And I would say we'd be remiss to not have a small discussion around AI.
Yeah.
Like what is it? Is it here to stay? Is it a fad? It's something I know you and I have been talking about pretty in depth over the past couple of quarters and even over the past couple of years.
Yep.
So just kind of sharing a little bit of information on how we're viewing it. This is a quote from Jeffrey Hinton, who won the recent Nobel Prize in physics this last year. And I think the quote is very in line with how we're viewing it. It is kind of akin to what happened in the Industrial Revolution
Mhm.
way back when, except today, instead of it being about robotics or this new technology replacing or exceeding people's physical strength, AI is actually going to exceed people's intellectual ability. So it's a massive new technology. It has huge capabilities for increasing productivity across all different sectors of the economy. Right now, obviously, it's been a very big tailwind for the technology space and specific manufacturers of chips, and so be it. But going forward, we see it really spreading out into the rest of the economy, and we do think it's going to continue to drive more specifically U.S. economic growth over the next handful of years and handful of decades. Honestly,
Yeah, I was listening to the presentation that Scott Ladner, who's the Chief Investment Officer of Horizon, I was watching that quarterly presentation. He was sharing how there's a lot of firms who will take what would typically require 4 days of research and development to be able to make a decision is now being done in a matter of a minute or two. And so, because it's going to assess more information than you can pour over and not miss an important detail. So, I've been bumping into AI for a while, and for whatever reason, just that simplicity of a statement of taking 4 days of work and putting it into a minute, there's an acceleration there that's gonna come for sure. Yeah, so that's a good point, and I know I've got clients who are a little bit concerned about AI and all the different things that could come with it, and I jokingly say, well, it's going to be your friend until it's not. So, but in the meantime, it could be your friend for the stock market, right? For the portfolio.
yeah,
Yeah.
absolutely. And then, beyond that, we've been talking about just how strong the, US economy more specifically has been. And really the driver of the strength in the US economy over the past couple of years has been the consumer. Continued strength on the spending side from the consumer has really been significant. There's been lots of concerns and lots of headlines, and we've even talked about in the past just around how much debt has been accumulating on the consumer
Hmm.
side. And that's absolutely true. There's no way to look around it. This chart on the right hand side, the blue lines there do show the total debt balance for the US consumer. It's moving, pretty substantially higher and to the right. That is a concern, although you have to take it into context. Can the consumer absorb that additional level of debt? And so you have to take incomes into account. And so that's what the red line shows. It shows that debt relative to income. And you can see that's been pretty steady and actually declining over the
Hmm.
past handful of years. And realistically, since 2008, the consumer in the US has really been deleveraging their balance sheet. And so we really think that, yes, while the debt level is moving higher, it's still in a place that's pretty healthy. Um, and going forward, what can continue to drive consumer spending is these lines of credit on home equity. We all know that over the past handful of years, home prices have moved substantially higher. That's been great if you've owned your home over the past couple of years. A little bit less great, obviously, if you're a new home buyer trying to get into the market. But what this means is that there is a substantial amount of liquidity currently sitting on the sidelines for homeowners here in the U.S. $35 trillion is not a small number. So that's something that continues to give us optimism when thinking about the strength of the consumer heading into 2025 and beyond.
That's good. I appreciate you sharing both of those, Casey. What's interesting to me is how often I've bumped into the headline of consumer debt at all-time highs, automotive debt at all-time highs, and they leave that, I guess, as just clickbait as a teaser to try and get you to get engaged. But when you have the context of it being income adjusted, it looks it's again still shocking that the debt is moving as high and to the right as you said, but it seems more palatable when you bring it into context of what people can afford and how
Yeah,
their wages have moved actually at a greater rate, it seems, because the line is decreasing than the rate of
yeah,
indebtedness. So that's a
yeah,
positive.
yeah, absolutely. Um, and so, yes, the consumer continues to be very strong. We've been talking about that as a real source of strength for the U.S. economy. But one area that we've been talking about that's maybe been a little bit weak is on the business side, and more specifically, just the sentiment around small business owners, and that's what this chart here tracks. So basically, it's asking small businesses, are you more optimistic or pessimistic about the next 6 months? And you can see the last couple of years, broadly speaking, we've been in a unique period where small business owners have been a little bit more pessimistic about the
Hmm.
economy. And that makes sense, right? We've had a much higher interest rate environment. Inflation has been a real source of pain, especially for small businesses. So, what does that mean from a small business outlook perspective? If you're concerned about the future, that means that you're probably not going to make that additional hire unless you absolutely need to. That means you're not going to invest in some maybe necessary improvements or new sources of technology, things like that. You're just not going to make those investments into your business. So that, in all things equal, does not help grow the economy. But we've had a pretty substantial change, I would say, in sentiment over the past couple of months, where small businesses are finally starting to feel a little bit better. We have seen inflation come down. We've seen interest rates move lower throughout 2024. There's optimism around the new administration cutting regulations and maybe better tax policies, things of that nature. So it's been really, really positive for our personal outlook here, seeing that sentiment on the small business side has changed as much as it has over the past couple of months.
Yeah, that also is encouraging. And I guess so we're still at about 70% of GDP is consumer consumption, and I think if you add corporate consumption, that's like another 20%. So about 90% um, of our economy is driven by consumption. So your business owners are going to have a hand in that as far as cash flow moving through the system.
Yeah, exactly. So, yes, I would say our outlook here at Horizon is pretty optimistic on the economy. But we know that the economy is not the stock market, and the stock market is not the economy.
Yep.
What has been driving the stock market and just broad risk asset markets more recently has been interest rates. And this is something, again, that we've talked about every single quarter for the past handful of years. We know that there's been a lot of volatility in interest rates, and the outlook for interest rates has changed from more cuts to less cuts. But more recently, and especially within this past quarter, there's been some substantial changes with the outlook for the path for interest rates in 2025 and 2026. So the chart at the bottom basically shows that, at the end of September, the expectations were for interest rates to be cut roughly 6 times in 2025, and not too many actually in 2026. So the majority of the work that the Fed was going to do was going to be over the next 12 to 18 months. Um, a lot changed, I would say, in the fourth quarter, especially around the Fed's most recent meeting in December, where all of a sudden they started talking about potential policy changes with the new administration coming, maybe increasing inflation. And essentially, what they were talking about is, the threat of tariffs, which we know are inherently inflationary. So they started baking some of these potential risks to inflation into their models. And basically, what that did is it pulled out a handful of interest rate cuts in 2025. So moving from about 6 rate cuts expected at the beginning of September to now at the end of the year, essentially only 2 or 3 were expected in 2025 and not too many in 2026. So it does seem like we're in kind of this higher for longer interest rate environment. Part of the reason for less rate cuts is the fact that the economy continues to be so strong. The Fed has that dual mandate where they care about unemployment, which continues to be very healthy, and inflation. So right now they're a little bit more concerned on the inflationary side, but I would say we're still more optimistic with the number of rate cuts throughout the next handful of years being a little bit more than one or two. So all things equal, that should be another tailwind for the economy, but not without its volatility, I would say.
Yeah, for sure. It seems like, you know, things being what they are, we've seen really strong performance in 2023 and 2024. So, I think haven't looked at it recently. It's been actually a couple of months, but we were basically printing about $1 trillion every 100 days. So that has to be somewhat inflationary, right? Just to keep the lights on. So it seems like if things continue to go well, we may actually look at a few hikes, right? Which would be, I won't say unprecedented necessarily, but just not expected. It
Yes.
seems like the market was really banking on that cheaper money, and we may just not need it. So,
Yeah.
especially your larger, from what I'd seen, your larger firms back during the lower interest rate environment regime, they really locked up a lot of their long-term debt. So it's going to be the younger business owners or the people who are trying to do expansions with higher interest rates that might feel that pinch. Kind of like what you're saying. Great if you own the home already, like the established business owner, but terrible if you're trying to buy maybe. So, or possibly challenging. I shouldn't say terrible.
Yeah, and I would
Yeah.
say also with the interest rate volatility or this higher for longer interest rate environment, that benefits certain parts of the economy and certain parts of the market a little bit more specifically. We know, and we've talked about small businesses tend to have more debt on their balance sheet. So all things equal, this higher for longer interest rate environment is a little bit worse of an outlook for them versus your large cap or mega cap companies, your Amazons, Apples that have so much cash on their balance sheet. Higher interest rates are kind of meaningless for them because they don't have really any floating rate debt on their books. And so that's really what we have seen over the past couple of years, where the strength has been in the equity markets more specifically, has been in these mega cap companies. We've talked about the Magnificent Seven.
Yeah.
They've been so strong in driving the majority of the gains and indexes. And thinking about why they've really outperformed. Yes, they have a lot of cash on the balance sheet, but they also have a whole lot of growth that they are seeing from an earnings standpoint. So the chart on the left-hand side shows broad technology and their earnings growth rates versus the rest of the market. And you can
Wow.
see there's a massive difference there. 29% versus less than 4% for the rest of the market. So
Hmm.
it makes sense that that's where investors have gravitated towards over the past couple of years. Yes, I would say there's concerns around the valuation of some of these companies with them trading at really extreme multiples. That's absolutely a concern. But going forward, I think what gives us a little bit more optimism, especially as more diversified investors, is the fact that the rest of the market is expected to start catching up. So technology and these mega cap companies, we don't expect them to completely go bankrupt, obviously, or really falter very much at all. But it's really the rest of the market we're expecting to start catching up. And again, the rest of the market is what's trading at more attractive multiples. So that gives us a lot of optimism and encouragement for our portfolios heading into 2025.
Yeah, I'm tracking with you on that. It does seem like the diversification really did hurt people who weren't in those FANG or, sorry, it was called FANG years ago, Magnificent Seven
Yeah.
stocks. And now it'll be interesting to see if it does a rotation to the other 493. It seems like the valuations are a little bit more favorable. And I know that NVIDIA has been making money hand over fist, but right now it's another one of those situations where I'm afraid that if they begin to falter, it could bring down more than just themselves. You know what I mean? As far as losing confidence or maybe investors trying to find that next hot dot. So it'll be interesting to see how that plays out as well.
Yeah.
All right. Yeah. Yeah, that covers the piece that I was looking at. I know we were talking about possibly being too optimistic, that certain components of the market had gotten too bullish. but it seems like there's some bright spots even with some of those more defensive plays or some of those dividend blue chip type plays. Maybe let's just say the other 493 to be safe.
Yes. And to your point, I would say if there's one concern that we have heading into 2025, because we are pretty optimistic, I would say about equity markets, especially domestic equity markets in 2025. If there's one concern that we would have, it's that there's a lot of shared sentiment around optimism for U.S. equities. And so basically, if everybody's kind of on the same side of a trade, or if everybody's moving in the same direction, it generally doesn't take as much to knock everybody off course. Or if you get some negative, newsprint that comes out, or some specific company underwhelms on performance or expectations, that could be what causes some downside volatility. So all else equal, we're very optimistic, but there could be some volatility here in 2025.
Yeah, it'll be interesting to see how some of that plays, some of the push and pull, whether it's interest rates or the stock market, or potential policy change with the new president and things like that, to see what actually ends up playing out. I know the market was reacting a little bit over a couple of weeks, trying to digest some of um, um, President Trump's potential changes that he's proposing, that it could be more inflationary in nature. So again, watchful waiting as usual. But I think just even going back to our investment committee meeting that we had recently, there's no actual changes for this model, which is really encouraging. That tells me that from our perspective and our opinion, we actually had that properly allocated 3 months ago. So hopefully, this is one of those situations where we're like Wayne Gretzky and we've skated to where the puck will be, and that's why we're able to hopefully win. So. Um, that's good. That's a lot of the notes that I had that I wanted to cover with you, Casey. Is there anywhere you wanted to go for today?
No, I think that covers all the main talking points. Yes, I would say again, remain optimistic. Yes, there are some scary things that are out there, but that's pretty much always the case. We're definitely looking forward to another very strong 2025, and we'll be obviously watching for risks along the way, and maintaining our flexibility with our asset allocations.
Yeah, same. I think I'm actually grateful for the performance we've had in 23 and 24. There's always places where you can enhance things and tweak things, but the models that we've been running have been really thankful for. So appreciate all the support from Horizon and the work that you guys do with us to help co-create all these models. It means so much, Casey. Thanks again.